I see it.
Hey everyone, it's Shauna the Tax Goddess. I am so excited to be here with one of our partners, Mr. Steve Blackwell. Now, it is tax planning season, and everybody's in the mood for a new investment that's going to save them a bunch of money and hopefully make them a bunch of money. And so I wanted to invite Steve, our partner, to come chat with us. I know we got a million questions from our audience. So Steve, why don't you tell us who you are and what you do?
Well, Shauna, thanks for having me on. And you're right, it's fourth quarter, right? Officially tomorrow. So everybody that's waiting until the end of the year has got to scramble around and figure out some tax strategies. So I appreciate you inviting me on the show. I'm Steve Blackwell, CEO of Invito Energy Partners. We're based out of McKinney, Texas, which is in the Dallas area. So happy to talk about all things oil and gas.
And that's good because we have like 10 questions that all came in on oil and gas, Steve. So I'm just super excited to ask you. So we're going to dive right in, okay? Because the chance to speak with an expert such as yourself, and at some point, Steve, we're going to have to get you on a different recording or something because your history with oil and gas is like this long. So we'll have to get all the details for everyone. So what are some of the options right now, as you said, fourth quarter, and I know these things go quick. What are some of the options to invest directly into oil and gas if that's what I want to do?
Yeah, so obviously, if you're a believer in the asset class, right, you could invest into stocks, bonds, ETFs, things like that, mutual funds. But if you want to go the direct route, you have a couple of options. You can buy what's called producing assets, which would be producing wells or producing royalty interest. Or you could buy non-producing assets in either the same categories, working interest or royalties. The only one the IRS sets up to have a tax-efficient upfront structure is to acquire and invest directly into the working interest of brand new wells. And so working interest may be a term people aren't familiar with, but just think of it as equal to equity. So it's basically equity in a well, that's called working interest in the oil and gas market. And if you put your capital into something where the capital is going into the drilling of new oil or gas wells, there are significant tax benefits that come with that.
And so amazing. The government, as usual, is incenting people to do things it wants, like help us produce more oil and gas, I assume.
Sure. Yes. And so it's been around since the 70s, right? For those of us that are old enough to remember, the United States was very dependent upon foreign oil for many, many decades. These laws were put back in place in actually the 70s. And so it's incentivized, as they use the tax code to incentivize capital to flow to the areas they want. And they're still in the code. They've been there forever, which is a positive in the sense that there's not audit risk here. These aren't on the watchdog list of the IRS. There's tons of case law here. So from an audit standpoint, there's essentially no audit risk when it comes to, is this a strategy the IRS is targeting or will question?
And definitely something that taxpayers like, right? Some taxpayers want to be really risky and go try the new things. And some taxpayers, listen, I just want the things that are tried and true and trusted. And that's what we're going to do. So what are the tax benefits associated with going this path?
Yeah, so the main one is called the main oil and gas benefit is called the IDC deduction. And so the IDC stands for intangible drilling costs. So to try and explain this as best I can, when you drill a well, there are two types of major costs: intangible drilling costs and tangible drilling costs. The difference between the two is exactly the definition of the terms being used. Intangible is anything that goes in the ground that when the well is done and over, there's no salvage value. Tangible is the complete opposite. Things like pipe, casing, production equipment, things that potentially could have salvage value, the IRS qualifies that as tangible. The intangible drilling cost typically makes up 75 to 85% of the total cost to drill a well. And Section 263C of the IRS says that you can take 100% of those costs and deduct them or otherwise write them off in the year of investment. So to make an easy example, if someone put in $100 and the intangible drilling costs were 80%, they would be able to take $80 and write that off in the year of investment. So if you put money in 2024, so there's still time, you have to have your money at risk before the end of the calendar year. Whatever the IDC is, that will show up on your K1 in March as a loss. So that's the main deduction. It's called the IDC deduction. It's 263C. The remaining portion of it is the tangible cost. And since you're an accountant, I'm talking to an accountant, you'll know this better than I do, right? But those remaining costs, those 15 to 25%, are amortized over 5 years, or you can take bonus depreciation on as much of those as you can. Although I think that's 60% this year, 40% next year, unless Congress passes.
Yeah, I was going to say, we'll have to see who gets into politics and who does what, right? But yeah.
So you'll still have some, and as the GP, general partner that manages the fund, we will take as much bonus depreciation as we can. But the main upfront year of investment tax benefit is the IDC deduction, and that's 263C of the code, and it's been there for a long time.
Well, and so one of the questions that we get really often is, okay, great, I'm putting in, let's say, $100,000, and I'm going to get a deduction for $80,000. Well, if my tax rate is 30%, right, then I'm getting $80,000 at 30%, so $24,000 of actual cold hard cash back in the first year. How do I make up the difference between the 24 of cash that I get from taxes and the 100,000 that I put into the investment? Where does that money come from?
Yeah, it's a great question, because unfortunately, sometimes people get led by the nose, unfortunately, by just this pure tax, which the tax strategy is fantastic for this investment, but it is an investment, right? So we want, like any other investment, we want to make money, and we certainly want to get our capital back, right? So it depends on who you're investing with and where they're investing into new wells, but I can tell you what Envito Energy Partners does. So my background, I've been doing this a long time, an executive of upstream oil and gas companies for many years. Essentially what we do now is we acquire what's called non-op working interest. In other words, we are acquiring equity or working interest in the wells that are being drilled by the largest E&P companies in America. And we are acquiring small pieces, small fractional interest, aggregating that and putting that into a fund. And that does a few things for us. One gives us diversification, so we avoid concentration risk. So we don't have like all the money into one or two wells, and if something goes wrong. And by targeting non-op working interest of the larger companies, we're getting inside proven operators, but we're also targeting what's called their tier 1 acreage, which essentially just means the probability of performance is significantly higher, because we are not going into areas where there aren't already a bunch of wells already drilled in the same area. That's a very short way to explain it. Obviously, it can get much more technical than that, but that's what we do. And then as the wells come online, right? So we're targeting, when we underwrite, we're targeting like a 2-to-1 return, 15 to 20% annualized returns, 30% minimum IRRs. The wells start to come online as they produce the oil or natural gas. They sell the hydrocarbons. We take that capital and we make the quarterly distributions to the investors. So again, our target, this is Envito, I'm not speaking for everybody that does this, we're always targeting return of capital in 3 to 4 years. Then we are everything beyond that as a return on top of your investment. That doesn't include the tax benefits. And then it's always a minimum of at least a 5-year hold. And again, you'll know about IDC recapture is the same thing as bonus depreciation recapture. You don't want to sell too early, because then you're kind of just giving back the tax benefits. So it's always a 5-year hold. The money that is raised in the fund will be used to acquire small pieces of working interest of the largest companies out there: Exxon, Marathon, Pioneer, Newborn, you name it. Well-capitalized and well-positioned firms. In the wells where they're putting hundreds of millions of dollars to work, you're going to put your $100,000 alongside of it, which may seem impossible to do. And by the way, they don't let us do this. We get into their wells without they don't have any say in it. We get into their wells because we acquire the mineral interest, and that's what we aggregate, put it, and the cash flow that comes off, we distribute that to the clients.
And so the big picture here for people that are not in oil and gas, right? There's really a million different ways you can get into oil and gas. And the question is, would you rather get into oil and gas with the big players that know what they're doing, that know where they're drilling, that know what's going on? Or would you rather, I don't know, I bought some land out in Texas and I'm hoping it's going to produce, right? So different ways to look at your due diligence of who you're working with on any given deal.
I mean, it just really comes down to data. So at the end of the day, in oil and gas, it's called tier 1, tier 2, tier 3 acreage. And commercial real estate, it's class A, class B, class C space, right? Tier 1, class A space, same kind of correlation. The difference is simply the amount of data. So when you're in a tier 2 or tier 3 acreage, you might be looking at a location and maybe there's 1 or 2 other wells within 3 miles. Or maybe in a tier 3, there's no other wells within 3 miles. The probability of the returns being what you expect with that minimal of data is significantly lower compared to tier 1 acreage we do a 3-mile radius, there's dozens of data points. And so that acreage is all owned by the big companies. So the only way to get into that is to acquire non-op working interest. And so you're 100% right. That's how one of the ways you manage risk. And in terms of being conservative in your underwriting is another way to do it. So, and I did forget one of the huge tax benefits, but we can go back to that in a minute if you want.
Tell us. We're all about tax benefits. Tell us.
So, I mean, the home run for oil and gas is the IDC deduction, right? Yeah. But think about this. This is a total passive investment. You are not running Invito Energy Partners. You are not running the fund. So the biggest problem everybody's familiar with commercial real estate, right? Well, if you want to offset ordinary income in commercial real estate, you have to qualify as a real estate professional, right?
Yep.
Or maybe you have to look at STRs,
yep.
right? So in qualifying as a real estate professional, that has to be pretty detailed these days. So oil and gas is a totally passive income, but they allow you to take that upfront IDC deduction and offset ordinary income. So that's why CPAs like yourself love it. That's why wealth managers love it. When they have high income earning clients who have a lot of taxable income that's ordinary, that $80,000 loss can take, your tax bill or your AGI and reduce it by $80,000. So that's the home run for oil and gas, because you can offset passive income if you have it, but you can also offset ordinary, which is what makes oil and gas very unique from a tax planning strategy.
And again, it goes back to, what is the federal government trying to incent? Do they want you to do this or do this? And so they're giving these special free bonuses in special ways that you get to deduct. So love it. Love it.
Yes. So
the audit risk, you talked about it, really low. It's been around since the 70s. If I'm super, super, super conservative, like I want, our scale, right? 0 to 10, 0 meaning the IRS never calls you never ever. Are there certain types of investments we look at, or like seriously across the board, they're a level 0? Or are we talking level 3? What do you think here?
Well, I would think, for this particular deduction, it's 0 or 1. But if you're going to go look at, plenty of the other strategies that are out there, conservation easements, so on and so forth. Some of the strategies around film financing, some of the strategies around, those are all in the code. But look, you can pull up, don't trust me, just pull up the IRS's dirty dozen list, right? Yep. You don't see this on there, right? So the IRS will tell you every year what they're looking at. And this is not on the list. Now it gets bantered around every 4 years for an election, right? But that has nothing to do with the audit risk. So I would say, in terms of someone looking at this specifically, just because you're taking advantage of the strategy, I'd call that a 0 or a 1.
Love it. And we agree 100%. Yeah, there's something to be said for the 70s. We're now at 54 years worth of court cases and laws and everything else surrounding this.
Well, and of course, it's not one of these strategies where you're getting like a 3 to 4 to 1 deduction based upon your investment. Those are the ones that are all over the IRS's hit list or watchdog list, if you want to call it. So nothing wrong with those strategies. Not saying don't do those strategies. I'm just saying you need to be okay with that, the audit risk that comes with it.
Well, and in my mind, it's a part of a diversification thing, right? So just like you don't buy all your short-term rentals in one location in one city in North Carolina that just got wiped out by floods, right? Yeah. You look at oil and gas and you look at this and you look at that. So what percentage, if I'm a new investor and I like oil and gas, right? I think, yes, we're going to need oil and gas. I think this is something. Do you have any idea on diversification of portfolios? So like, is there a max of 10%, 20%, 30% that your investment should be into oil and gas? Do you have any opinions on that?
Yeah, I would say that it depends on what your allocation percentage is to alternatives in general, right? So some people there are people that still follow the 60-40 stocks and bonds. Now, if that's you, then this is completely out in left field for you. So this is kind of a moot point. But if what's becoming more of a traditional allocation is maybe 60-40 and that 40% being alternatives, right? Because alternatives are a very big umbrella of assets today. I would say that you're looking at a 5 to 10, maybe 15% allocation. I don't think you should take any one asset class and over allocate to it. That is illiquid. Now, again, remember, this is an illiquid asset. That's the number one thing your clients, one of the main things I have to make sure everybody understands, this is not a stock or a bond where you can just get your money out tomorrow. This is an alt. Some alts do have redemption periods, but this one does not. So you're in this. Once you put your money in, you're in. So that can affect that allocation piece. what also can affect that allocation piece is if you just have, in a particular year, you just have a massive tax bill, right? Because whether it's maybe some stocks were exercised, you sold an asset. I just talked to a Southwest pilot this morning. I had no idea they had this big contract renegotiation at the beginning of the year. All their pay got raised. They got paid 5 years of back pay, and they're all of a sudden have this huge income for 2024, and they're going to get, whacked on taxes unless they do something. So maybe that affects that allocation portion. But again, the number one thing from an allocation standpoint for this fund, this investment type, is to make sure you are putting in liquid assets that doesn't affect your liquidity needs.
Yeah. Well, and that was going to lead to my next question, which is, so I've put my money in. I thought I wasn't going to have any liquidity needs. Like I thought we were good and that was fine. Something happens. Can I use this as collateral? Can I get bank loans against it? Nada. Okay. No. So once it's in. This is locked up.
Yeah. So like one of our subscription document questions is exactly around that. Is this money that you may in any short or midterm need? I'm just saying, this is not helping me. I'm telling you, don't invest if you have any potential need for that in terms of liquidity.
Yeah.
Because it's illiquid. I can't say it any clearer. It's an illiquid investment. There are alts that have redemption periods. This one does not.
Yeah. Okay. So, and we like clarity, right? Because you do not ever want to get somebody involved in something that is not right for them. So what are the minimum requirements for an investor to even look at something like this?
Well, we're a 506c offering, so you do have to be accredited. And beyond that, it's, our minimum investment's 50 grand. You can invest in increments of 25 from there. And I think, for the clients that looking at it, I think it's for clients that, one, have the liquidity, two, have looking for tax strategies because they have a lot of taxable income for 2024 on the ordinary side. You're also looking for diversification in your fund. Having alts, the beauty of alts is it doesn't trade on a daily basis. That's why that allocation of 60-40. There are plenty of different alts. Right, you're in the stock market. You're literally the value of your portfolio is going up all day long, right, up and down. So you can kind of smooth out the risk or the volatility in a portfolio with alternative assets. So if you're looking for some uncorrelated assets, you're looking for some tax strategies. Also, if you believe in the commodity itself, which we obviously are very bullish, especially on oil over the next 5 years, for many different reasons. But natural gas as well. We're not as bullish on natural gas, but we've primarily focused on oil. This is an asset class to look at, but the tax benefits are huge. So if you can take advantage of that and get that 25 to, because you can't offset state taxes, so it depends on where you live. That could be 30 to, if you're out in California and you're in the top tax bracket. We did the math. It's like a 40%. It's like a 40% return just from signing the paperwork, which is crazy.
Yay for California. poor Californians every time.
Yeah, yay for California for the wrong reason.
For the wrong reason. Cheers to that.
Because you're getting taxed to the roof. Yeah.
Well, and so what is the most asked question of you when somebody is coming to you and this is their first time investing in oil and gas?
I think they just, what is the risk to it, right? So, and it's very difficult to answer that question from the way I would typically answer that question, which is very technical, right? Because you're not going to understand, or the client's not going to be able to understand a technical question. So the way I answer that question is, look, I've done a lot of alternative investments or private placements myself, a lot of commercial real estate. So I look at a lot of deals, and this is agnostic to the asset class. But when you're looking at private placement deals, you want to have to start, if you're talking about risk, because you should be asking that question, right? Can I lose my money? And how would I lose my money? What would cause that? But you have to look at who the team is, what is their background in the space, and then the number two question you have to answer for yourself, which requires you to do some work, which means read the PPM a little bit. People just don't want to do that. Is you have to answer the question, is there alignment with the sponsor between you and them? In other words, how are they getting paid? And is that aligned with you? And what you want to avoid on any type of private placement is someone that's making a significant amount of money up front. And what I call significant is once you get into the 15, 20 and above range up front. And then beyond that, you already are misaligned at that point because they're making money regardless of the performance of the asset. And then is there any way where the performance of the asset and the way the sponsor gets paid so that you guys are aligned? That's the number one way to manage risk. I could sit here and tell you all the technical things that we do, and I'm happy to do that with anybody. We do that with people all day long. But this is oil and gas. They're drilling holes in the ground. It's a very technical business, right? There's reservoir engineering, there's production engineering, there's drilling engineering, completion engineering, there's the geologist function of it, there's risk, it's a very technical business. And so what you want to know is, do we, the sponsor, whether it's me or somebody else, have a background? Do they have technical people on their team? Have they worked for larger companies, smaller companies? And then how was the deal structured? So, I had literally with the Southwest pilot today, I said, look, I could be completely full of crap. You don't know, but look at the way I structure my deal. If I'm full of crap and I'm just trying to get your money and I'm not going to perform, if you see the way my deal's set up, I'm not making any money. What's the point of me doing that? So that's how I asked that question. And that question definitely gets asked.
Love it. And it should be. You were 100% right. Risk and how do you get paid?
And that's with every private placement deal, not just oil and gas.
100%. 100%. And Steve, this is why I love you, because you are an upfront, super blunt, super direct. Here's what it is. Here's the thought. And there you go. So, Steve, how do people find you if they want to find you, if they want to learn more?
Yeah. And, our website is Invito, which is sometimes hard to spell, which is INVITOEP. Call Shauna. Ask for a tax strategy. That's how you find me. Call Shauna, ask for a tax strategy. She'll point us to us. But you can look me up on LinkedIn, connect with me on LinkedIn, invitoep.com. You can see our website, click on current deals, which take you to our current data room. But I would say call someone like Shauna and tell her you're looking for tax strategies, and, she'll help you get to the right one. She may not even point you to me. Maybe she's got a better one somewhere else.
Well, Steve, I'll believe it when I see it, but thank you. That's very sweet of you. I love it. Steve, it has been such a pleasure today. Thank you so much for joining us. We wanted to give everybody a little taste, all the things that you need to know, especially as we're heading into fourth quarter and everybody's about to write some big old checks if you didn't do tax plan. And so thank you so much for your time today, Steve. It's such a pleasure to have you with us.
It's been awesome, Sean. And the last thing I'll say is you can go to YouTube and type in Invito Energy Partners and watch my boring videos on how to navigate oil and gas investing. You need something to help you go to sleep? Check it out.
I love it, Steve. I love it. Thank you so much. And thanks to all our watchers out there. We will be back soon with more information and some additional fun tax strategies for you guys. So stay tuned. Join our YouTube channel, Tax Goddess on YouTube. And if you have any questions, don't hesitate to reach out. Thanks so much, Steve. Have a great day.
Thank you, Shauna. Take care.
Bye.